I'm Alan Kenny, and we're in New York for REIT Week 2017, NAREIT's Investor Forum. I'm joined by Scott Crowe, Chief Investment Strategist with Center Square Investment Management. So Scott, easy question here to start off. Where do you see real estate values going in the rest of 2017?
Well, I think most investors on the private side, particularly those focused on the core gateway market, should expect their total return to approximate their yield. In other words, I think that what you'll see is that private real estate prices will continue to flatline. We definitely saw a deceleration of returns over the last 6 months, and if you look at what the public market's been doing, the REIT market, for the last almost 2 years now, which is very, very flat in terms of price return, it's certainly signaling that the very strong low-teen returns we've seen from core real estate are behind us. And that's for two reasons. The first is the tailwind of cap rate compression is largely over. And the second reason is that now, almost 10 years into the recovery, we have engineered somewhat of a supply response in core gateway markets, which is seeing not negative rents, but certainly a pretty significant deceleration in NOI growth to closer to the 1% to 2% level.
So then which property sectors do you see offering the best growth?
It's hard to go past the strong fundamentals of single-family rental, data centers, and industrial warehouse distribution. I mean, these are property types that are firmly in the positive trend of changing demographics and demand trends as it relates to also technology as well, which has been a huge driver of demand for real estate and changing demand for real estate. One of the non-consensus areas is retail, and it deserves focus because I think it's shaping up to be to near a point of a snapback. There seems to be a lot of hysteria around retail, and I think some of it's justified because retail is going through a permanent repricing as an asset class. Traditionally, it's enjoyed 100 basis point lower cap rate because of the sustained and visible growth coming from that asset class. And that's over, given what's happening with online shopping, but also the fact that the department stores have just not changed their business model. So retail should be priced much more closer to the average pricing of the average real estate asset class. That's happened already in the REIT space. You have Simon Property trading on about a 6.3% implied cap rate. And so I think that repricing's largely happened in the REIT space. And what you're seeing, if you look at, say, the debt market, and the debt markets tend to be a lot less imaginative than the equity markets. You're seeing good access to capital still for companies like Brixmor and DDR. They're issuing bonds at 3.5% to 4.5% for 7-year money. And what that tells you is that the underwriters on the debt side are certainly just looking at the cash flows that are coming out of these companies and believing they're going to get paid back. And so I think what's likely to happen is that people realize that, retail's going through a pretty dramatic repricing. The story has evolved away from, just owning high quality versus low quality. The whole sector's going through disruption right now. But this will take a long time to play out. And there's still good cash flows coming from those businesses. So in a nutshell, I think retail is a great non-consensus area to be looking at right now.
And how concerned are you in general with supply?
It's one of the most important things to be focused on at this point in the cycle. And it's important to understand the issue early. Number one, and you can see that if you look at storage. Storage is newer to the party, if you will, in terms of the supply response. And you have to acknowledge that up front, that this isn't a small thing, that you have to really understand that what this is going to do is significantly decrease NOI growth for a period of time. But secondly, you also have to understand when it's priced in. And I would say the apartment market is a good example of that. Forward deliveries basically peak out for the traditional residential apartment space at the end of this year. And so if you can find a point in time, such as 6 months ago when the apartment market was still trading at pretty good discounts to NAV, yet the forward deliveries are slowing down, then that's also a good entry point.
Well, lessons learned, I guess.
Exactly.
Thanks so much for your time, Scott.
Thank you.
And for more on this and other real estate news and analysis, be sure to visit REIT.com.